p.m. only on Bloomberg Quint.
Well, Syngene International Private Limited has reported the March quarter earnings, and the top line growth, the company has registered a 30% growth out there. Bottom line performance too, we see a 19% uptick there. Joining to take the discussion forward is the CEO of the company, Mr. Jonathan Hunt. Hello and welcome to Bloomberg Quint, sir. Hi, this is Nikki, and I'm going to be starting off by asking you about the strong performance that we've seen both in discovery services and development services business. I'd like to understand what is the growth that we can see going forward in FY20 now.
Okay, thanks, Nikki. Yeah, good performance. We're very happy with the quarter. 30% revenue growth in the fourth quarter. I think if you look at it throughout the year, if you look at the prior quarters, 28% revenue growth for the full year. So good trends, getting stronger through the year. So we're sort of very happy with the progress we're making there. The bits that have driven that are, I think, our Discovery Services group is at a particularly strong year. Now, Discovery Services is a collection of services that we deliver, so chemistry, discovery biology, bioinformatics, and also safety and toxicology. Often they're sort of delivered on a standalone basis, so just one of those. But at the same time, we also integrate them into a combined service package, and we're seeing good demand growth for that element of it as well. So a very strong performance in there. It's probably got up to about a third of our overall revenues coming out of Discovery Services. I think the other group that's had a very strong year is the dedicated centers. This is where we partner in collaboration with clients over multiple years, and we build and then staff and run dedicated research centers for them. It's quite a long cycle business. It's very sticky because it's often multi-year contracts, but they're also very long in the gestation period. They take a long time to build those sort of partnerships, and we saw a number of those come through this year, which has given us that boost on the overall year, bringing performance in at the top end of management's expectations for the year.
All right, Mr. Hunt, I'd like to ask you about the new client addition in quarter 4, or the quarter just gone by. And also, what is the trend that we can foresee in FY20? How is the momentum right now?
Yeah, I think it's very good, and there's a number of factors I think I would point to. Now, the disclosure we made around new logos added wasn't for the quarter, it was actually for the full year, and that was 15 new client relationships during the course of the year. That delivered some of the growth. An equal amount of the growth actually came from expanding and extending the relationships with existing clients. So as we build, an experience based with them in one service area, they often then move across and pick up services in other areas. So those two elements of growth. In terms of the market outlook, I think it's very healthy in sort of two areas. Major pharma companies, major biotech companies globally are continuing to evolve their strategies. So it's a hybrid combination of doing research in their own labs plus partnering with companies like us. There are very, very few companies that go with a standalone, only doing things in-house strategy. So that's driving growth. And I think the second area is a very buoyant market around the world in scientific startups and mid-sized companies that are getting good capital funding, and then they're looking on how they can bring their science forward. And for many of them, it's a smart decision to partner with a company like Syngene. We can provide all of the infrastructure and the capability they want when they need it. We can do it with speed and with scale, and we can do it without them having to put their resources directly into capital infrastructure. So all of the infrastructure and skill sets they need, but without having to put it on their own balance sheet. And I think the combination of those two is giving very sort of healthy demand for our services.
All right, deviating a little bit from there on, then I'd like to understand any kind of updates on your upcoming API manufacturing facility at Mangalore.
Yeah. Let me put that into the context of what the business is today and where we think it will evolve over the next sort of strategic plan period. Essentially, Syngene's business today, and it's roughly a third, is dedicated centers, these strategic partnerships with major clients, discovery services, and then also development services. I think the next strategic evolution for us, and it starts, making the investments now, but it starts to operationalize from next year, is around adding to that a fourth business category, which is around commercial manufacturing. And that has two elements. It has the Mangalore plant that we're building, which is a small molecule API plant. That will be, it's under construction this year. That construction and qualification should finish by the end of FY20, but that clearly means it's not a revenue driver for this year and will only be in startup phase in FY21. So slow contribution to, and building contribution to revenue throughout FY21. The second element of that manufacturing strategy is a little bit more advanced, and that's in biologics. We brought online a biologics manufacturing facility here in Bangalore about 18 months ago. Things are progressing well with that. It's a small facility, but it's doing well with client wins, and we took the decision this quarter to expand that again, and we're going to double the capacity of that, and that will be done throughout the course of this year. That should then start to operationalize and contribute to revenue growth in FY21. So both of them really are more about the CapEx investment stage of that program for FY20, but then we'll have good capacity in place for the long term.
All right, Mr. Han, I'm going to ask you, before getting on to the CAPEX plan, I'm going to quickly chat a little bit about your debt situations and the plan to deleverage. I believe the debt situation right now is around 3,396 crore.
Yeah, and we made the first installment of that during the quarter in terms of payback of the US dollar denominated loans. We've got a clear plan in place to pay that off as it comes through to maturity. And I think if you look at the cash flow sort of performance, cash generation within the business, you can see that we can do that without too much of a stretch. So I think we're in a pretty good position in terms of both our capital structure and our ability then to service and pay down that debt.
All right. Does the company plan to be a cash-rich, or rather a debt-free company by FY20 in that case?
Yeah, it's not something I would comment on. I think there's an element of that which is around future investments in the business and the rate at which we will continue to either reinvest and/or acquire new capabilities. And we keep a healthy watching brief on that, as you'd expect. Our priorities today are very much investments back into the business, and you can see that with the capital investment program that we've already laid out. That's a $550 million program that runs, so 2 more years to run, so it should complete by FY20, the end of FY21. By then it'll be $550 million. We're quite a way into that as of today. We've already invested $350 million of that into the business. So $200 million more to go, and I think if you just straight line that between the 2 years, you wouldn't be far wrong in the rate at which we'll be investing into new capabilities and capacity in the business.
All right, Mr. Han, I'd like to understand the additional capex of $200 million is envisaged by FY21. I'd like to understand, would that be funded through internal requirements?
Yeah, we can fund that with the capital structure that we've already got, either from cash flows from operations or from with the debt that we already have in place. So it's a continuation of a program that we'd already laid out rather than a change in strategy.
All right. Then the last question that I have for you in that case would be a little understanding that you could give us a ballpark figure that we could work with for this ongoing financial year now. The company for top line growth, it's a 28% uptick for FY19. And in terms of margins, however, they seem to have shrunk to 32% as compared to 35%. What can we expect going forward in FY20?
Okay, so I mean, we in general, we have a policy of not giving earnings line-by-line guidance, but let me try and talk directionally around it. So 28% revenue growth in FY19. If you bridge that from reported revenue back to underlying sales, so you've got to adjust for the FX impact, 6% FX benefit during the course of the year, gets you down to sort of a net 22%. growth. There were a couple of one-off items through the revenue line in the year, which I wouldn't expect to be recurring. That's probably 2 percentage points of growth. So you get to an underlying sales growth in FY19 of about 20%. That, I think, is a good indicator of what we would expect in FY20, maybe even a notch higher in FY20, so maybe a percentage point or so above that. So that gives you a good sense of where we're going on revenue. On the margins, I think the EBITDA margin for the year, as you said, was 32% margin for FY19. Absolutely in the middle of where we expect to be long term. If you look at our 5 and 10 year historical averages, low 30s at the EBITDA level is about right for the business while continuing to invest and to deliver growth. So I think that's a good indicator of where we would expect to be in FY20. And then at the PAT margin level, this year came in at 17% PAT margin at FY19. Pretty good indicator, I think, for where we'd expect to be in FY20. Maybe a 1% swing on that, one way or the other. Could be down a little bit.
All right, Mr. Hunt, thank you so much for that, and thank you so much for talking to Bloomberg Quint.
Thank you.